Silver investors, if you own more than 100 ounces right now, this is not just another silver video. At 100 plus ounces, you are no longer a casual stacker. You are a large holder sitting on a position that can change your financial year in a single month. At Friday's price zone, 100 ounces is not a trinket. It's an $8,000, $13,000 slice of your net worth, depending on where you bought and which market you reference. At 500, 1,000, or 5,000 ounces, you are talking about 6- and 7-figure exposures to one of the most volatile, structurally distorted markets in the world. This video is not for the person with 5 coins in a sock drawer. It's a briefing for people whose next decisions in silver will actually show up on their family's balance sheet. Sit down, close your other tabs. For the next 20 minutes, we're going to treat your 100 plus ounce position like what it is. A serious, high impact bet that deserves the same level of planning you'd give to any other major investment. This is financial warfare education, not financial advice. I sell nothing. No courses, no groups, no signals, no mentorship, no fund. Anybody using my name asking you for money is a criminal. Verify everything. Your decisions, your responsibility. Let's get into it. Segment 1. Why 100 ounces is where the game changes. Let's start with the threshold. At current Western paper pricing, 100 ounces is roughly $8,000, $9,000. At Shanghai physical pricing, that same 100 ounces is already valued several $100s higher. Below 100 ounces, your position is a hedge, an insurance policy, a conversation piece at best. If silver doubles, it's nice. If silver halves, it hurts your ego more than your life. Above 100 ounces, everything changes. A routine 10% move in silver, something we've seen several times in single sessions in 2026, is an 800 plus swing for every 100 ounces you own. The 31% intraday move we just saw in late January was a $2,600 swing per 100 ounces, $13,000 per 500 ounces, $26,000 per 1,000 ounces. Those numbers are not theoretical. They happened recently in one trading day at 100 plus ounces. Liquidity is no longer trivial. Exit strategy is no longer optional. Tax and reporting are no longer background noise. Storage, security, and insurance are no longer, I'll think about it later. From here on, your silver is not a hobby. It's a position, and positions need management. Segment 2. Know exactly what you really own, structure and vulnerabilities. Most silver holders can't answer a basic question. What exactly do you own and how can it fail you? They say, I have silver. That is not an answer. We're going to break this down into buckets because each structure has a specific risk profile. 1. Physical in your possession. Coins, bars, rounds in your safe, hidden cash, or private storage you directly control. Strengths. No counterparty risk. No margin calls. No forced liquidation. No cash settlement surprises. The exchange cannot screw this up for you. Your broker cannot have an issue and vaporize it. Risks. Theft, fire, flood, or physical damage. Liquidity friction once you cross 100 plus ounces. Selling 10 ounces is easy. Selling 200, 500, or 1,000 ounces fast at fair price in a stressed market is not. Local dealers might not have the cash to buy your full stack at spot on a panic day. Widen spreads aggressively when volatility spikes. Online dealers require shipping and insurance, authentication time, settlement windows. If you're a 100 plus ounce holder in physical, you must know which 2-3 dealers can actually handle your size. Their real buyback spreads versus spot in calm and stressed conditions, how fast they pay. That's not a later task, that's a this week task. 2. SLV and similar unallocated ETFs. If your 100 plus ounce exposure lives in something like SLV, you hold a claim on a trust. Custodied metal at a bullion bank. Exposure to COMEX pricing and prospectus language, not warehouse doors you personally control. At normal times, it's liquid, tight spreads, easy in and out. But these are not normal times. SLV has seen multi-billion-dollar outflows and tens of millions of ounces redeemed this year. Its custodian also happens to be one of the biggest players in COMEX delivery and concentrated short positions. Your specific risk, if paper and physical prices diverge further, Shanghai versus COMEX, SLV will track the paper side. That means your screen can show losses while real physical in tight markets is rising in value. If you're 100 plus ounces deep in SLV, you need to understand you are betting that the paper pricing mechanism remains credible exactly when its stress indicators are flashing. 3. PSLV and fully allocated vehicles. PSLV and similar vehicles offer fully allocated metal, named bars, independent audits. Your counterparty risk is the trust structure, the mint depository, the jurisdiction for PSLV Canada. Different risk, not no risk. Premium risk, PSLV can trade at a premium to NAV. Buying at a 4% premium and later seeing that premium compressed to 0% is an instant 4% hit regardless of spot. At 100 ounces equivalent, that's hundreds of dollars of structure risk, independent of silver's move. 4. Futures. If you're expressing 100 plus ounce risk via futures, you are playing with matches at a gas station. A standard COMEX silver contract is 5,000 ounces, hundreds of thousands of dollars of notional exposure depending on price. Levered par 15-20x against your margin, depending on the latest hike. We just saw a 31% intraday move. That's 6 times the margin for a heavily levered trader. If you're using futures to represent your 100 ounces, a modest adverse move can liquidate you. You can be right on the long-term thesis and still get blown out on the path. 5. Mining stocks. Here you're holding silver price exposure, plus management, jurisdiction, cost, and equity market risk. Miners typically move 2.3x silver on a percentage basis. Great when you're right. Brutal when you're early or wrong. At 100 ounces equivalent, that leverage can still be manageable. At 1,000 plus ounces equivalent all-in miners, your personal volatility goes parabolic. Action item. Tonight, write down exactly what you hold. How many ounces each line represents, how each line can fail or be impaired without silver going to zero. Clarity first, decision second. Segment 3, cost basis, the psychological landmine under your feet. At 100 plus ounces, your cost basis is not trivia. It's the anchor for your tax bill, your risk tolerance, your emotional reactions. Examples from the transcript's logic. 100 Oz bought at 25. At current levels, you're up roughly 5,000 plus. A 20% drawdown hurts but doesn't nuke your conviction. 100 Oz bought around 75. Your unrealized profit is modest. A 12 to 15% drop can wipe your gains and flip you into red. 100 Oz bought into January's spike above 110. You're currently underwater. Every dip feels like proof you were stupid. Every rally is, finally I can get out. 3 different cost bases, 3 different psychologies, 3 different risk profiles. Homework. Write down the exact cost basis for each silver position. Physical, ETF, futures, miners. Write your unrealized PL at today's price. Decide in advance how much drawdown you can tolerate before you make any change. If you can't look at a realistic 20-30% drawdown scenario without panicking, your position size is wrong for your nervous system. Segment 4. This specific window. Why the next 30 days are not like the last 30. We're not in a generic period. We're in a cluster of stress factors that rarely overlap this tightly. The transcript outlines a major COMEX delivery month approaching, with first notice days away. Open interest in the front month representing multiples of registered ounces. A paper-to-registered ratio north of 3:1 just in that month. Chinese export controls on silver now deep into their second month, with no clear path to reversal. Shanghai spot and premiums meaningfully above COMEX. Physical priced higher than paper. Multiple margin hikes already implemented, with the possibility of another. That mix creates 2 real scenarios. Bullish. More contracts stand for delivery than expected. Registered supply tightens further. Price spikes violently to incentivize selling or divert metal into the system. Bearish. More longs roll than stand. Delivery stress is manageable. The imminent crisis narrative cools, and price retraces as hot money leaves. At 100 plus ounces, your job is not to pretend you can predict which path we take. Your job is to have a written plan for both. Segment 5, 2 scenario planning, spike and flush. Take a blank page, 2 columns. Column A, spike scenario. Example. If silver trades above X, 90, 95, 100, choose your number. During this delivery window, I will sell Y% of my tactical position. Keep my core physical untouched. Rotate part of paper exposure into cash or other assets. Column B, flush scenario. Example. If silver trades below Y, 80, 75, choose your line. As stress eases, I will add Z ounces to my core stack. Reduce or exit over-levered exposure that isn't letting me sleep. Refuse to panic sell long-term holdings unless my absolute floor is hit. Write down the prices, the quantities, the action, not I'll see how I feel. How you feel in the moment is exactly what gets you killed in this game. Also note, Sunday night's futures open often drifts lower first. Historically, a majority of sessions have seen initial red into thin liquidity before full markets engage. If you're over-levered into that, a small drop can cause outsized mark-to-market pain, forced reductions, or outright liquidation. Your plan is the difference between being forced to act at the worst possible time or choosing to act on your own terms. Segment 6, insurance, the boring part that saves you from real-world disasters. At 100 plus ounces, there's another risk that beats market drama over a 10-year horizon: theft, fire, flood. Most standard homeowner policies cover a few $100s of bullion by default, not $8,000, not $80,000. If you have 100 ounces at home, 8K, 9K load exposure, 500 ounces, 40K, 45K, 1,000 ounces, 80K, 90K. Ask yourself, if my house burned down tonight, how much of that would my current insurance actually cover? For For many people, the answer is a few $100. Action items for 100 plus Oz holders. Call your insurer. Ask specifically, what is my bullion coverage limit? Do you offer scheduled coverage or riders for precious metals? What documentation would you require in a claim? Then, photograph bars with serials visible, photograph tubes and coins clearly. Store images and receipts in a secure cloud or off-site backup, not just next to the metal. If you're using a private depository, read the storage agreement, confirm insurance limits per client per vault. Understand whether you're fully covered or self-insured above a cap. This is not exciting content. It is exactly what separates someone who survives a non-market disaster from someone who loses a lifetime of stacking in one night. Segment 7, the 30-day written strategy. Stop winging it. The next month is a pressure cooker, delivery, export controls, margin changes, macro data, geopolitics. At 100 plus ounces, you cannot afford to just see what happens. Your 30-day strategy should answer, on paper, what percentage am I willing to sell in the next 30 days? If the answer is 0%, write that and accept that you're writing everything, both up and down. If the answer is 25% above X price or 50% below Y price, write those triggers down. How much additional capital, if any, am I willing to deploy? If we get a deep flush, will you add? From what source of funds? Up to what size? What is my absolute pain floor? The price where, regardless of thesis, you cut to preserve solvency. It might be far below current levels, but it must exist. What is my 12-month target for this position? Not a prediction, a benchmark for your own expectations, e.g., if silver is at or above 120 within a year, I consider this successful. That target helps you frame dips as noise versus opportunity. When the market moves, pull that paper out before you open your broker app. Let the version of you who is calm and rational make the call, not the version who just watched a 5% candle. Segment 8, large holder mindset versus small trader mindset. If you own more than 100 ounces, you are not playing the same game as someone buying their first 10 coins. They can make impulsive decisions with small consequences. Turn stacking into a hobby and content. You cannot. Your job is not to nail every wiggle, win every argument online, buy the exact bottom and sell the exact top. Your job is to protect principle, avoid catastrophic mistakes, let asymmetry work in your favor when the big cycles move. That means respecting structure, how you hold, respecting size, how much you hold, respecting time, how long you can hold. Conviction without preparation is just hoping. Preparation without conviction is just hedging. You need both. Segment 9, the checklist before the next open. Let's simplify this into a checklist you can literally run tonight. Count your ounces, know your total exposure across all forms. Map your structures. Physical ETFs, futures, miners, list them with exact ounces. Calculate cost basis and PL for each position separately, not just overall I'm up. Identify exit channels, 2 local dealers, 1 online. How much they can buy, how fast they pay. Confirm insurance home, vault, riders, and documentation. Write your spike and flush scenarios, prices, percentages, actions. Write your 30-day strategy, max sell, max add, pain floor, 12-month target. This is not busy work. This is what serious 100-plus ounce holders do while casuals argue about memes. Segment 10, where this leaves you as a 100-plus ounce holder. If you own more than 100 ounces of silver today, you are sitting in front of a market with real structural tailwinds, inside a system with real structural distortions, at a moment with real measurable volatility catalysts in the next month. That combination can multiply your wealth if you're prepared, or magnify your mistakes if you're not. The people who will walk away from this period with the best outcomes are not the loudest on social media, the most extreme in their targets, the ones screaming, "I'll never sell," the loudest. They're the ones who knew exactly what they owned, knew exactly what could go wrong, had a written plan before the fireworks started. You've been watching John A.G. here, and I'm OG John A.G. If this helped you think like a 100-plus ounce operator instead of a casual silver tourist, hit like so this doesn't get buried, subscribe with all notifications on, and drop a comment. 100 plus ready if you've got your structure, cost basis, and 30-day plan on paper, or fixing it if today is the day you stop calling a 5-figure metals position just a hedge and start treating it like the serious exposure it is. Because on this channel, we don't let 6-figure swings depend on hope and vibes. We verify, we plan, and then we let preparation do what luck never will.